There are moments in markets that don't announce themselves with explosions or headlines. They arrive quietly, disguised as routine pauses, calendar gaps, or harmless-looking closures. But for those who've watched enough cycles, these moments stand out immediately. Because when markets go quiet at the wrong time, pressure doesn't disappear, it concentrates. This is one of those moments. Right now, silver is entering a window where normal price discovery doesn't operate the way most people assume. Trading slows, liquidity thins, and oversight becomes reactive instead of continuous. On the surface, that sounds calm. In reality, it's when imbalances matter most. Because whatever stress exists going into a blackout doesn't get resolved, it gets deferred. And deferred pressure has a habit of reappearing suddenly. What makes this particular window different is the setup. Silver hasn't been drifting aimlessly. It's been moving with intent. Volatility has increased, but more importantly, structure has tightened. Moves are sharper. Reversals are faster. Liquidity isn't as forgiving as it was even a few months ago. These are not random traits, they're symptoms. Markets rely on constant feedback to stay orderly. Prices move, reactions follow, adjustments are made. When that loop is interrupted, even briefly, the system becomes vulnerable to gaps. Not just price gaps, but expectation gaps. Participants go into a closure, assuming stability, and come back to a different landscape. This is why experienced institutions pay close attention to timing, not just direction. A move during active hours can be managed. A move during reduced oversight changes behavior. And reactions tend to be more extreme because they're compressed into shorter windows. Silver is especially sensitive to this dynamic because it sits at the intersection of paper expectations and physical reality. Futures, options, and derivatives trade continuously when markets are open. Physical supply doesn't adjust at the same speed. When trading pauses while demand signals remain unresolved, the disconnect widens. That's the danger of a blackout. It doesn't create pressure, it reveals it. Most people assume nothing happens when markets are closed. That's the mistake. Decisions still get made. Positions still get evaluated. Orders line up. Risk committees don't sleep, they prepare. And when markets reopen, all of that preparation hits at once. This is why some of the most violent moves in financial history didn't start during normal trading. They started at the edges, after holidays, over weekends, during periods when control was assumed but not active. Silver doesn't need a catalyst to move during a blackout. It only needs unresolved tension. And right now, there's plenty of it. If you're watching only price, this window feels boring. If you're watching structure, it feels loaded. The difference between those two perspectives is everything. What intensifies the risk during windows like this is the false sense of safety they create. When trading slows or pauses, many assume volatility pauses with it. But volatility doesn't disappear just because price stops updating. It accumulates. Expectations build. Imbalances remain unresolved. And when the system restarts, everything that was delayed tries to clear at once. This is where structure matters more than sentiment. Sentiment can change quickly. Structure doesn't. Silver has been carrying structural tension for some time now, built from a combination of positioning, leverage, and assumptions about liquidity. Under normal conditions, that tension is managed incrementally. Small moves relieve small pressures. But when the feedback loop is interrupted, even briefly, the release can be abrupt. Liquidity is the key variable here. During active markets, liquidity acts like a shock absorber. Orders meet resistance gradually, prices adjust in steps. During blackout periods, that buffer thins. When markets reopen, liquidity has to absorb everything at once: new information, repositioning, delayed reactions. If it can't, prices jump to where balance can be found. Silver's challenge is that its liquidity is uneven. It looks deep on paper, but it's not uniformly flexible. Certain price zones are well defended, others are thin. When a move pushes into one of those thin zones, especially after a pause, price doesn't negotiate. It relocates. This is why gaps tend to appear after closures, not during heavy trading. The market isn't discovering price in real time. It's reestablishing it. And reestablishment is rarely gentle. At the same time, positioning into these windows becomes asymmetric. Those who are comfortable with risk stay put. Those who aren't reduce exposure or hedge aggressively. That imbalance creates a lopsided setup. If price moves against the majority expectation, reactions are forced rather than voluntary. Silver also carries an additional layer of complexity because it's tied to industrial demand cycles. Unlike purely financial assets, it can't be treated as abstract. Physical considerations impose constraints that don't pause just because trading does. Supply chains continue. Demand signals persist. That creates latent pressure that doesn't show up on charts until the market reopens. This is where many observers misinterpret what follows. They see a sharp move and look for a trigger, a headline, a piece of news. Often there isn't one. The move was preloaded. The blackout didn't cause it. It allowed it to express itself. The danger isn't that something unexpected happens. It's that something expected happens faster than models allow for. Risk frameworks are built around continuity. They assume time to adjust. Blackout windows compress time. For silver, that compression matters. Because once price jumps, the reaction isn't limited to traders. It affects hedging behavior, margin requirements, and confidence in near-term stability. Though secondary effects can amplify the initial move, turning a repricing into a cascade, none of this guarantees direction. What it guarantees is sensitivity. Moves become more decisive. Reversals become sharper. And complacency becomes expensive. If you understand that, you're already ahead of the noise. Because the real story of a blackout isn't what happens during it, it's what the market looks like when it ends. As the blackout window approaches its end, the market enters a subtle but critical phase, anticipation. This is where behavior begins to shift before any visible change occurs. Traders, institutions, and risk managers start positioning not for what they know, but for what they can't see yet. And that uncertainty changes everything. During these moments, assumptions are quietly rewritten. What felt safe a few sessions ago is suddenly questioned. What looked liquid is treated with caution. Exposure that once seemed manageable gets reevaluated through a tighter lens. This isn't panic, it's prudence. And prudence, when widespread, alters market dynamics more effectively than fear ever could. Silver's structure makes this phase especially unstable. Because it's not just reacting to financial expectations, but to physical realities that don't pause for calendar events. Industrial demand doesn't switch off during closures. Supply constraints don't ease because trading desks are quiet. When these ongoing pressures meet a reopening market, the result is rarely smooth. This is also where volatility takes on a different character. Instead of building gradually, it appears in bursts. Price moves feel abrupt not because something sudden happened, but because multiple adjustments are being processed simultaneously. Orders that were deferred collide with new positioning. Hedging flows overlap with speculative reactions. Liquidity is forced to absorb it all at once. What complicates matters further is how narratives lag these shifts. By the time explanations surface, the move has already occurred. Analysts scramble to assign meaning. Commentators debate causes, but the market has already done what it needed to do. It has cleared tension. Silver's role in this phase is diagnostic. It reveals how much stress was embedded beneath the surface. A calm reopening suggests balance. A sharp repricing suggests imbalance. Either outcome carries information, but only one captures attention. And attention, once drawn, tends to amplify reactions. This is why reopening periods often feel disproportionate. A relatively modest change in underlying conditions can produce an outsized move because the system is processing delayed information. The longer the delay, the stronger the reaction tends to be. Another factor at play is confidence. Blackout windows tested indirectly. If markets reopen smoothly, confidence is reinforced. If they don't, confidence erodes quietly. Not enough to cause immediate disorder, but enough to change behavior going forward. Participants become quicker to reduce risk, slower to add it. That shift persists. Over time, repeated experiences like this reshape how a market is treated. Volatility becomes expected. Liquidity is priced more cautiously. Risk premiums adjust. The asset doesn't need to fail to be reclassified. It only needs to behave unpredictably at key moments. For silver, unpredictability during these windows matters because it challenges the assumption that it can be managed passively. Once that assumption weakens, the market's character changes. It becomes more sensitive, more reactive, and less forgiving of complacency. This is the stage where outcomes diverge sharply between those watching structure and those watching noise. One group sees confusion, the other sees transition. As the market transitions out of anticipation and into reaction, the effects of the blackout become clearer, not through a single dramatic move, but through a series of adjustments that signal a change in behavior. This is the phase where the system reveals what it learned during the pause. Liquidity doesn't simply return to its previous state. It re-enters cautiously. Participants test the depth of the market before committing fully. Early trades are smaller, more selective. Volatility often spikes not because of new information, but because the market is feeling its way back into balance. That hesitation creates gaps between expectation and execution. Silver's position magnifies this effect. Its market isn't uniformly deep across all price levels. Some zones are well supported. Others are thin and reactive. When reopening activity pushes price into one of those thin zones, the market doesn't negotiate gradually. It adjusts decisively. That's why reopening moves can feel exaggerated compared to the information driving them. Another important shift happens in risk perception. Even if the move itself is contained, the experience of uncertainty lingers. Participants remember how quickly conditions changed. They become more alert to timing, more sensitive to closures, and less willing to assume stability across calendar gaps. That behavioral change influences future positioning. This is also where official narratives start to reassert themselves. Explanations emerge to frame what happened as orderly, expected, or contained. Sometimes they're convincing. Sometimes they're not. But the market's memory doesn't rely on narratives. It relies on experience. And experience tends to override reassurance when similar conditions appear again. Over time, these cycles create a feedback effect. Markets that have reacted sharply during blackout windows are treated differently going forward. Risk premiums rise, hedging becomes more active. Volatility is priced in earlier. That doesn't mean the market becomes unstable. It means it becomes less forgiving of surprise. Silver's broader significance lies here. It becomes a reference point. Not because it always moves first, but because when it does move under constrained conditions, it reveals how the system handles uncertainty. That information gets embedded into behavior across related markets. For many observers, this phase feels anticlimactic. There's no single moment that resolves everything. Instead, there's a gradual realization that something has changed. The market doesn't behave quite the way it did before. And that difference matters more than any one price level. Understanding this phase requires patience. It's tempting to look for conclusions, but systems under stress don't provide neat endings. They adapt through uneven steps. Recognizing those steps as they happen is what allows informed observation rather than reactive response. We are now approaching the point where the effects of this blackout will be reflected not just in price, but in how participants approach risk going forward. What ultimately matters after a blackout like this is whether silver moved up or down in a dramatic way. It's whether the market returns to its previous rhythm, and that's where the real difference tends to appear. Once a system has experienced compressed time and delayed reaction, it rarely resumes behavior exactly as it was before. The final phase is defined by adjustment, not resolution. Participants incorporate what they've just lived through into their expectations. They become more aware of timing risk, more cautious around closures, more sensitive to signs of latent pressure. That awareness doesn't fade quickly because it's grounded in experience rather than theory. For silver, this means the market becomes more reactive at the margins. Moves don't need to be large to feel significant. Liquidity responds faster to uncertainty. Volatility doesn't wait to be invited. This doesn't signal breakdown. It signals a shift in how risk is priced. Most importantly, the blackout reveals how much of the market's stability depends on continuous engagement. When that engagement pauses, even briefly, the system's ability to smooth imbalances weakens. That lesson stays with participants. It changes behavior going forward, often in subtle but lasting ways. This is why blackout windows matter even when nothing spectacular happens. They test assumptions quietly. They show where pressure is stored. And they remind everyone involved that markets don't reset cleanly after pauses. They carry memory. For viewers watching closely, the takeaway isn't to expect chaos. It's to recognize sensitivity. The environment after a blackout is different from the one before it. Decisions are made with more caution. Reactions are quicker, tolerance for surprise is lower. If you followed this entire breakdown, you're already ahead of most narratives. You're thinking in terms of structure and timing, not just price. That perspective doesn't eliminate uncertainty, but it helps you interpret it without overreacting. I'm curious what you noticed around this window. Did volatility feel different? Did liquidity behave unexpectedly? Share your observations in the comments. These discussions matter most when the signals are subtle. And if this analysis helped you understand why these quiet moments can carry outsized impact, consider sharing it with someone who's still focused only on the visible moves. In markets, what happens when things pause often matters more than what happens when they're loud.